Welcome to Season 4 of the Knack for Business podcast.
So, a question to the audience. Are you tired of looking at financial reports that tell you nothing about where your business is really headed or how to grow it with confidence? Well, our guest will show you how to turn your numbers into clear strategy, uncover hidden profit opportunities, and build a financial system that actually supports scaling, not just compliance. You'll learn why most advisors keep you in the dark and how having one trusted partner for accounting, HR, strategic guidance can finally give you the clarity and control and momentum. Our guest today is Thomas Howard from Brightway Advisors. He's the business development director, where he provides outsourced bookkeeping, controller services, and operational support to help growing businesses stay financially organized and future ready, with a focus on accurate records, smooth cash flow, and compliance. Thomas and his team give business owners the confidence and clarity they need to make smart decisions and stay focused on what they do best. Beyond the numbers, he also leads Phoenix Swords, a historical performance group that brings history to life with live sword play and fire demonstrations, proving that whether it's finances or flaming blades, Thomas knows how to deliver precision, discipline, and unforgettable impact. In my mind, it was flashing, "Oh, we got a dragon over here. Let's go, make it happen." Thomas, welcome. How are you, sir? And do you have a favorite quarter saying?
Sure. So I am doing very well. To kind of go with the dragon theme, one of my favorite quotes associated with that is, "Do not meddle in the affairs of dragons, for you are crunchy and good with ketchup."
Now I'm. Why do I feel a sudden need for wings? So, what's the moment you realized business owners needed more than bookkeeping? That they actually needed the strategy in the game of finance and in business.
A lot of it came from my work before I came to Brightway Advisors in banking. So many businesses were, if you would look at their financial statements, seem profitable, but they kept running out of cash. They hit growth issues because they're trying to do everything themselves, and they really struggled in times of economic adversity because they didn't have good planning in place and good systems in order to be able to weather those storms. So when I had the opportunity to come over to Brightway Advisors and kind of put the skills in helping those people to use, it was just a natural fit, and I've loved every minute of it.
I actually spent a career dealing with a CA firm that was trying to sell beyond compliance, and it was
Mhm.
really hard slugging for the first couple of years because all they wanted was dead trees that they could hand to their bank a year later. Did you find any of that, and how did you fight it?
To the one of the things that we very quickly realized is that businesses don't speak numbers. Businesses don't speak finance, right? People who start their business don't wake up one morning saying, "I'm going to start my business," and then say, "Yay, math." So you need to be able to build reporting that lights up the targets for them, that they can understand and translates that financial story. You give them a more forward looking thought process so they can start planning and start putting in strategies to grow and reach what those goals are. Sometimes that goal is to grow and to scale. Sometimes it's to plan for a business exit. Sometimes it is just to try and get a better quality of life. They started their business thinking that they would have more freedom and control. Uh, they're finding that because they're doing everything, they're working 80 hours a week and kind of running on that hamster wheel. So financial statements, when they're structured properly, when you keep in mind that they need to be able to be represented in a language that people can actually understand, can guide people's path and light the way to what they're trying to achieve.
I seem to recall a day where I was in a manager's position, given a budget, and said, "Hi, build next year's budget and have fun at it." Left with many a question. So, Thomas, I totally hear what you're saying. Why does this matter? Is usually the question, not because the number was irrelevant. It was just more like, I don't understand how this component fits into the rest. I understood the component, I understood the name, I understood it was important, but, what does it matter? If it's off by 5 points, 10 points, you're over budget, under budget. And I always assumed that if you're generating more revenue, you're beating your milestone was the kind of the target. How do you get the person online to going, "Okay, the number you're looking at means this, and if it changes, means this." And then in context with everything else. The speedometer in your car, if you're doing 100 miles per hour, in context of a raceway, is good. In the context of a public street, neighborhood, no.
Yeah, so I think it's more of being able to relate everything back that the business owner is trying to achieve and what their ultimate goals are, and getting them to focus on the areas of those financial reports that are relevant to that. If you speak to what their passions are, you can then use that to guide them. One of the things that we're great at is a lot of business owners have shiny objects syndrome. They have this new idea, they want to go after it, and they want to go after this, they want to go after that. Well, by being able to sit them down and say, listen, you only have so many resources here, and we're already halfway through shiny object A. If we shift to shiny object B, we'll never complete shiny object A. Oh, and by the way, you're already getting a return on that investment in shiny object A. So do you really want to go after shiny object B? And that kind of, keeps the squirrel mentality from getting into their heads too often. And when you say these are your resources, you can do a bunch of things with that, but you have to be intentional with it. Keeps that focus on there, keeps them on that end goal.
So, Thomas, with blind spots, there's obviously a look at books, and books on themselves can be quite dry. Using your wizardry and your alchemy,
Mhm.
how do you find those bright spots coming out of a financial statement or dark spot?
Well, I actually have a recent story of a client we started working with in May. We got through the cleanup process. We reorganized the chart of accounts. Something the business owners were missing is that they had two outsourced fractional HR firms that were working with them, plus an HR director full time, right? Because of where that information was scattered, it wasn't categorized correctly. They had no idea what they were spending. So when we dove into those financial reports and were able to show them that, by the way, 10% of your gross revenue, which is more than twice what your net profit has been over the last 3 years, is being spent on HR, and you are not a 100-person company. That is something that we're able to point out and have them reevaluate what's going on in their business. And oh, by the way, even if that spend gets cut by 10% because we brought it to their attention, we've now paid for ourselves on an ongoing basis. So that's the power of having financial statements that people can understand, just going with what QuickBooks recommends and being able to categorize and sort those things so that that kind of spend jumps out at you and you can take action. Not everything is as glaringly obvious of that, but that's why we have teams of very highly experienced accountants that are all W-2 employees. They're all US based. They all have 4-year or higher accounting degrees, and they all have 5 years or more of practical experience. When you take that into account, yes, we're going to be more expensive than your standard bookkeeper, but you're not going to get that type of result where that kind of spend becomes glaringly obvious with just a bookkeeper. You need someone that knows financial operations, that knows reporting, and knows how to work with business owners.
Swinging back to the shiny object and squirrel at a rave. So if you've launched, let's say, product A, and that's kind of like, hey, this is going good, and we're getting ready to go to version B or another element, that's scaling. How do you prepare a company then to go, listen, you're about to go through an undulation. So here are the numbers, but from the strategy perspective, do you help them map out deployment and going, because sometimes, you can bake a cake, but if you forget to put the eggs in the batter, so to speak, till right at the very end, it becomes something else more like a pizza, right?
Right.
How do you get the right order of a sequence? Do you provide that, and do you provide insights, or do you provide while we're going through this, here's another expert in this particular area?
Yeah, so I said that's how we relate with fractional CFOs. Fractional CFOs are the chef, we're the recipe. So we're going to be able to show them what resources that they have, how they've performed to date, and even do some financial modeling so they know what the costs are going to be, projecting out what their return on investment is, and what point they'll actually break even and stop being profitable in that area, right? The CFO is then going to take that information and say, okay, now that I know all of this information, here's how we get there, right? We know that we want to be profitable with this in 5 years. Here's what we need to do these next 12 months, and this is what we need to do in the next 3 years in order to reach that 5-year goal. So fractional CFOs come from that future end backwards, like a chef does. The chef knows what the cake should look like, what the cake should taste like, and we're the recipe that builds the cake and has built the cake all that time. And we kind of meet in the present where we're coming from the past forward and they're coming from the future backwards. Sure.
Why is Brightway Advisors a better choice than Thomas Howard LLP?
Well, one thing is because I am a piece of our team, and we really do take a team approach to our clients. All of our clients have at least two people on their team, a operations associate and their manager. Sometimes we throw a consultative expert at the financial controller level from our insights team on there. So, we have 36 people on our team. I couldn't do this without them. I have accounting dyslexia being in banking for 21 years. In banks, deposits are liabilities and loans are assets. So I'm not the one people want in their books. I'm the one our accountants want going out, shaking hands, kissing babies, kissing hands, and shaking babies in order to drive the type of work that they love doing with our clients.
Yeah, that's interesting. So, helping them understand what they're looking at. Do you structure it? Is like in an industry, there's a certain typical approach that's different from other industries. Like, for example, if I'm a garage, a mechanic, a car dealership versus a restaurant versus a financial firm, where we're taking your money and putting it in places that are really good to grow, or even a lending institution, back to the banking days. Is there a different approach for each of these type of verticals?
Yes, and there's some verticals that can have vastly different complications than others. For example, manufacturing, you're dealing with a lot of inventory accounting. When it is food manufacturing, you're also dealing with perishable inventory as well. So being able to account for that, project out when that's going to be used so that you are never underutilizing your inventory, but you're not overstocking to the point where it's really going to cost you a lot of money is one of those things. In construction and in the trades, like you said, the garage mechanic, right? Every job has what's called a work in progress schedule. You have, often you have different people on different jobs, and you need to see as the job is going along how many labor hours you're putting in, what's the cost of the materials to make sure that those jobs stay on their budgeted track. And when they're starting to go off the rails, you know that ahead of time so that you can make adjustments and ensure that you're not losing your shirt on a job that you took on. So those are just two examples of verticals that have some complications in those. Some verticals are very similar to others, but that's why we have a team of 36 people is because we have people with different experiences in different industries so that we can directly speak to what the needs of those industries are, what reporting they need, and how that reporting needs to be structured because the people that generally own businesses have different levels of financial sophistication. A financial advisor is going to have much more accounting sophistication than someone who started a construction firm. So you have to
Thomas,
be able to speak to them on their level so that they understand.
I hope this isn't true for the medium of the small and medium. But what I've noticed with solopreneurs is even if you give them gorgeous financial statements and even spend the 40 minutes explaining, make all their decisions based on their bank balance. It's the only number they check, period. Even when they lie, they'll lie to you about how much they researched it. Is that true? You find?
It can be. I think that when a business is under 1 million in annual revenue, they're not ready for our services because they're not forward looking enough. One of the things that we do with the majority of our clients is a cash flow forecast, because what people don't realize is that the money you have in the bank may already be spent, right? So I'll give you an example. A contractor brings on a big job. They have $100,000 in the bank because they received that big deposit, right? But that money is going to be spent on this project over the next 3 months, and they're not going to collect the remainder that the 100,000 is covering the costs for until they get paid times 90 days in arrears. And what do you do in the meantime for your cash flow? How do you budget for that? What tools do you have in place? And more importantly, what happens if you don't get paid and you've spent all of this $100,000? What's your backup plan? How do you keep that from happening? solopreneurs and professional services aren't as, shall we say, exposed to something like that, except possibly um, personal injury attorneys and attorneys that collect when settlements are made. But for other industries that are growing and maturing, again, er, you have to kind of manage when bills are due and when you're collecting funds so that you have that smooth cash flow. By doing a cash flow forecast and projecting that out, you can see 10, 13 weeks out when an issue might come up. And now you can proactively address that. Hey, we just got this big order. If we don't do something in 12 weeks, we're going to be in a very bad cash position. Well, that's plenty of time to go to your bank and say, hey, I need to extend my line of credit. So, or to renegotiate terms with suppliers that you're getting from these jobs because you're going to have a longer cycle than normal to pay them back. It's not just about credit, it's about how you're managing your cash so that in 12 weeks you're not going to wind up sitting with a negative balance in your checking account before you finish a job that ultimately is going to make you $1 million once you get paid.
What are the tools that you usually, when you're doing a transaction, if I go to buy a candy bar, right? Buddy's bought the candy bar, maybe bought it for a nickel. He's selling it to me for a dime to help, A, cover the costs and cover the cost of his operation. And so there's a couple of things that have to be kind of mapped out. One, how much of a profit margin would be reasonable? And obviously reasonable means also someone's willing to pay it, right? What other tools do you have around the person's business? So is there enough margin built in to make it worthwhile? And then how much is worthwhile and how much is, geez, you're being greedy, but they're paying for it. Okay. Yeah, it's like certain concert tickets, right?
Right.
Of a star down south that she goes around the world tour. It's successful as all get out, but the tickets are like, oh my gosh, what was I thinking if I went and I haven't?
Yeah, and it really does vary what's healthy in one vertical as opposed to another. If you're a professional services firm and your gross profit margin is 50% and your net margin is 25%, then that's a pretty healthy uh, company there. But you are never going to see those types of profit margins in construction and manufacturing. They may only have a 5% net margin. And getting people to understand the difference between gross margin and net margin is really important because gross margin is what is the cost to producing the good or providing the service. Then your net margin takes into all of the other expenses that support that. So that's your HR staff, your admin staff, your accounting, things of that nature, so that you can see how profitable you are on the top line, how profitable you are on the bottom line. And when there's a disconnect, it really can drive where your focus needs to be. If you have good gross margins and those are being measured correctly and poor net margins, then there's something in the net margins that's out of whack. Conversely, if you have strong net margins, but weak gross margins, then you might not be charging enough for your services. And we know what that is because we can benchmark with existing clients and with general trends in the industry to provide targets for people to get to. And if you're underperforming or overperforming, understanding why is key, especially if you're overperforming. What are you doing better than your competitors that's giving you that edge? And how can you leverage that for your growth?
Something I saw that's different, you even gave us an example, and maybe that's the whole point. I've talked to a lot of people who are in the financial planning and accounting business in this podcast. You're the
Mhm.
first time I've ever heard HR in the sentence as the bookkeeper and CA. This is an actual point of your business. I want to know how that developed.
It's more of an extension that grew out of some of the financial work that we were doing. Many of our clients, we're not a payroll company, we're not a benefits company, but they have us do the company administration work to run their payroll and to administer their benefits to their employees through their providers. And because we're doing that, they had just assumed that we had that compliance knowledge. Well, we've now brought on somebody that does, and we can help with more compliance focused tasks like helping them with handbooks, writing job descriptions, and things of that nature. The internal person that we have is going to focus mostly on our clients that have 10 or fewer employees. And we're in the process of developing strategic partnerships with other firms that can handle either larger employee sizes or ones that have more of a, if you need 10 hours of HR per week, we're going to want a provider that we network with to come in and manage that. If you've got 5, maybe 10 hours per month, that's something Katie, our HR director, is probably going to be able to handle.
Left brain, right brain. I'm absolutely interested in banking and sword play. I could see there's parallels, and I could see some people being absolutely horrified when you met them at the party. Tell me a story.
Sure. So, for one thing, what I can tell you is that with Phoenix Swords, we can go more into that. When I perform with fire for our fire shows, I never perform without our safety team. And the worst thing that you can do when you're performing with fire is panic. So you have to be able to plan, you have to be able to drill in your safety protocols until they become second nature, and you have to do it so you never become complacent. As such, I can focus on my performance being brilliant. That translates very well into business. Doing those same habits, you're just using different tools. And then you can focus on your business performing brilliantly instead of trying to keep it from burning from to the ground. So the what the work that I do with the swords and the fire has helped build additional skill in the areas of helping people manage their financial operations and some of their HR.
In the world of handling the money, there are different mechanisms. There's your point of sale machine, and then there are, let's say you're in the manufacturing business, and all of a sudden you've shipped off to a large retailer, maybe 100 units, 1,000 units, and you're due back maybe 100K. Is factoring something that is a good idea? We heard someone else talking about this, right? Where you're keeping the cash for the cash flow emphasis to keep it good. But then also in the credit card industry, there's certain credit card companies. We're not going to pay you until say there's a 60-day cycle, right? And we're going to charge you more because we're pretty, bellow the ball, so to speak. I'm not quite sure why. Anyhow, do you help a company then go, "Hi, here are the tweaks also in that, kind of the back office piece?"
Yeah, we'll always make recommendations on that. But again, it comes down to every business is different. So whether factoring or other tools and resources are needed really depends upon the business, what tools they have access to, and how they need to access them. And I think that's one of the reasons why we do so well with our clients is that we customize our approach based on their needs, and then we can adjust that approach based on how their business changes. And as they outgrow other tools, we can help them implement newer tools, better tools for the stage that they're at. And there are some tools that we bring in to help with that too. There are programs that we're very comfortable with that if a client isn't using anything in the area to manage AP, for example, or AR, we can make thoughtful recommendations based on our experience with other platforms. But at the end of the day, we'll use what works best for our client. And a client's a good client if what they're using is as long as it's a modern days platform that's easy to access through the cloud, we're going to be able to use that and be effective. Where we're not effective and the types of tools that don't work well with our model is if you've got a system called System 2000, that's an AS400 DOS based system, we're never going to be the right solution for you.
"Here's my abacus. This is my financial computer. Let's have at her." Yeah.
Yeah. And you'd be surprised how many businesses out there are still running on platforms like that.
I've met a lot of entrepreneurs,
Mm.
and a lot of them are drivers, and they are so thrilled with their top line, and they brag about it. And we did 1 million last year, 2 million last year, and they don't have a clue that the bottom line is either very, very small, or in some cases negative. How do you broach that? Well, yes, we're absolutely thrilled about your top line. Did you know you could actually make more money at Walmart?
And that's again, that's the difference between gross margin and net margin. And really measuring that out and saying, listen, you're collecting all this money. This is how much you're keeping. So why is that? Right? What is out of whack? Is it your pricing? Is it your expenses? If you're able to bring on all of these clients, why can't you service them profitably? And sometimes it's structural and it's below those gross margins where they're overspending. Case in point, the company that I talked about overspending on HR compared to what they're bringing in for revenues. That is a perfect example of, hey, we're bringing in a lot of revenue, we're growing, but their bottom line isn't growing because there's an expense that keeps ballooning that they need to address and really focus on. So when you have things categorized, we go into the details, but we collapse them in the reportings so that the business owner has an idea of where the issues are. And if we need to expand out that detail to show a specific issue, we can. But if they're, say, spending $100,000 on administrative assistance and they have a 5-person company, is that really necessary for an outsourced virtual assistant? In some cases, it is. Some cases, it's not. But if you have a net margin problem, you're looking at things like that. If you're having a gross margin problem, that's more indicative of you're not charging for your services, your materials that you're getting, you're paying more than a typical competitor, or or the human resources that you have might not be worth the investments that you're making. So it comes down to where you see those problems. It kind of guides you of where your focus needs to be and the targets you need to light up in order for the business owner or the CFO to address what those issues are.
In the business world, every once in a while you see a high profile figure and they say, buddy over here is worth at least $10 billion, right?
Mm.
And it's not money that's sitting in a bank account just kind of sloshing around. There are a couple companies that I guess the money's
Mm.
sloshing around, but for the most part, no. How do you figure, what is the value? How do you figure, say for myself, I need to pay if I'm not in a job, I'm running the company or I own the company. How do I draw a coin out of the company? And how do I structure it so that, I'm not penalizing myself? Do I set up a trust? Do I set up, what kind of format do you have on there? I know I've touched on about 3 different things here: valuation, getting paid, and, tax liability.
So, tax liability is not something we can speak to because that's not work that we do. We usually work closely with our clients' CPAs so that they have an effective tax strategy. On the business valuation, there's a term called EBITDA, earnings before interest, taxes, depreciation, and amortization. And that is a good metric to see the value of your business. If you were to go sell your business tomorrow, that's the figure that a bank's going to use. And depending upon what industry that you're in, you'll get and how well your business is run, there'll be a range of multiples to EBITDA that they will pay for that business. So this gives you an idea if you're tracking EBITDA, and we do track it for many of our clients on how the decisions you're making are affecting the value of your business. And sometimes the EBITDA will shrink because you're making long term investments that are going to grow it significantly more over time. And sometimes it's, you're shooting yourself in the foot and you need to kind of restructure how you're doing things so that you're not hurting your EBITDA in ways that are going to eventually devalue your business significantly. That's the thing, too, is that you also need to let them know what buyers are looking for, right? A lot of companies, when we start working with them, the business owner's the rainmaker, right? They have the client relationships, they're making the deals, and many of them love doing that. But the problem is that if they don't have anyone else in the company doing that to the same or greater extent, well, then that business owner is never going to be able to sell their business. Or if they are, they're going to be handcuffed to it for a number of years because there's no value without them there. Right. And that I think is something that a lot of business owners, when they get to that 1 to 2 million in annual revenue, they're not seeing. And when they start to understand that, they start building in the management structures and they start getting out of working in the business and start getting into the habit of always working on their business. And once you have the financial resources to be able to do that and build that out, not only will you have a business that's of better value, but even if you're not looking to sell your business for 20 years, guess what? Now you can go on vacation. Your phone's not going to ring off the hook because you've built in the systems, the services, and the people so that you can go away for 2 weeks and your business is going to be just fine.
Thomas, you have clients that do warranty work as a big part of their business. Do you help them make sure they understand that's a reasonable expense so it doesn't catch them as a gotcha? Tell me about that.
Yeah, so it's all about how things are categorized. Now, I can't really tell you myself how that sausage is made, but it tends to be a deferred expense that you are planning and budgeting for, and you're looking at industry trending data and historical data within your business in terms of what you need to budget for when it comes to that, right? Part of that can be internal testing that you've done. Here's when a product will fail and why it will fail and how often it will fail. That can give you an idea of where to start. And then as you're getting different things in, different data in, you then adjust your planning accordingly, right? So I think it depends upon how much pre-planning there was, how much testing there was on a product or a service, and the likelihood that you are going to have to make repairs or make replacements. That gives you an idea of how much of that revenue needs to be set aside to take care of that. But again, it's not a perfect science. And if you've created a product that few people have seen before, and didn't have the resources to really test it like a large engineering firm would, you need to kind of build in the factor that that there are unknowns out there and you should have a reserve set aside accordingly. And if historical data shows that, hey, we actually over prepared for that, then you can tighten that up and put that capital to use elsewhere.
It's interesting how you just mentioned that with the testing. I'm gonna go on a little bit more on in the warranty, space. There was a, car manufacturer, from overseas,
Mhm.
Asia, and what they did was for their warranty, the design engineers had a budget, and, so if things came back under warranty repairs, that was covered under their internal budget. In other words, if you designed it wrong, and there's a lot of people, so there's like, it's an immediate effect on the system. Do you just like when you're helping a business construct something, and especially when they have multiple departments,
Mhm.
do you have it so that the internal budget is also going, hey, your quality control is kind of amiss, or your staffing, like, you don't have enough staffing. If it's, the company has a Black Friday and they have a lot of consumer products, right? And let's say they're electronics even. And there's gonna be a momentum, "I need that," right? And there's a sale. How do you make sure that they understand that and inside the company? It's one thing for the owner to understand it, but even the layers beneath the owner, right? How do you provide enough feedback so they go, "Oh, yeah, I didn't clean the floor," and that could be a problem in a restaurant.
Yeah. So part of that is to show historical data so people can plan accordingly and see what the life cycle is. And you break it down to things they can understand. Hey, last year, 70% of our revenue came in between September and November. So we know we're going to be really busy during this time. We know that we're going to have more expenses during this time and more revenue. So what do we need to do between December and August to prepare for that? How much stock do we need to prepare for? What do we need to be looking at in the marketplace to determine whether we can expect a busier season or a slower season? And how do we manage inventory? And when do we ramp up that inventory relative to when we're expecting the sales to come in? And what cash flow tools do we have to manage that slower time so that we can keep the skills of people on our team and put them to use to help grow the company in different ways? So again, it all comes down to looking at what's gone on before and what's likely to happen in the future. If you're a newer company, you've only been in business for a couple of years, well, then you're looking at your industry, right? Where are there those peaks and valleys? in your sales cycle that is typical in your industry? Do you start seeing that start to play out in those first couple of years that you're working in? And, that's the whole point of not looking at your bank account to see if you're profitable, right? Because if you're doing 80% of your sales in September through November, right? And you've taken in all this profit, you're like, I'm I'm doing extremely well. But you have that profit is going to help fund your business operations from December through August. So you need to set that aside to prepare for that, or you're going to get caught flat footed. And now you're going to be scrambling for financial resources because you decided that, hey, I've got $2 million in profit in the bank and I'm going to pay myself 1.9 million. Well, thing is probably about 1.5 million of that is already spent.
There's a term I've heard called financial intelligence. I'm interested how you take data, legitimate data, correct data, and use your crystal ball to decide what your competitor is doing, what tariffs could happen. Are there, where do you put on your wizard hat and how?
So part of it is that what you're looking for is some sort of balance between best and worst case scenario, right? And what's the worst thing that could happen? What's the plan if it does? And that all comes down to risk management. And from a financial perspective, we can model that out. And if they don't have good risk management, then we'll refer somebody in that we network with in order to have them build out those plans. And then a best case scenario is, what do we do if we're more successful than we ever wildly dreamed? How do we keep our growth from being cancerous, right? How do we build in those systems and prepare for those systems so that if the best case scenario happens, we're able to build that out and take advantage of it, right? Companies can very easily become victims of their own success where they didn't plan for a best case scenario. And now they have all of these orders coming in for either their services or their products. And now they don't have the manpower to be able to deliver. So their quality goes down, their wait times go up, and the end customer is a lot less happy. And yeah, it's great that all this came in, but now, if 70% of those people have a bad taste in their mouth, they're never coming back. And it's going to hurt your reputation. So there's risks for underpreparing in both areas for best and worst case. And I think people are kind of trained in our culture to prepare for Murphy's Law, right? Whatever can go wrong will go wrong, but they don't plan for what if everything goes right beyond our expectations. And that's where we try and help them kind of see where that is. You also have to remember that there is always going to be unforeseen circumstances at both of those ends, right? Not everyone it wasn't clear what the tariff chaos was going to be a year ago. There wasn't a clear picture a year ago who would be in the White House to begin with, right? So there's a lot of uncertainty there. So you need to be able to plan around that, but you might not pull the trigger on those. But if you've planned for it, that's a good thing. The other part of that too is that when the pandemic came along, no one was expecting the world to shut down. And the people that had planned for, if we have resources for a long-term disruption, can we implement those? Those are the businesses that kind of thrived during the pandemic because they had those put into place. They were prepared for not necessarily the pandemic, but what happens if our revenue dries up for 3 months, right? Can we still stay in business? What are the things that we need to do to stay in business during that time? They had a worst case scenario planned and they got through it, where others that didn't have a plan, their businesses either failed because they weren't able to get PPP funding in time, or they really struggled and it hurt their growth. So it's all about planning and making sure that you have the right resources in place. I was still in banking at the start of the pandemic, and I was in a networking group. And about 2 months before everything happened, I was giving a talk on why a line of credit is important. And I said, you want the line of credit before you need it, because by the time you need it, it won't be available. And when the 2008 crash happened, the companies that survived and then later thrived were the ones that had a tool like that in place for emergencies, even if they didn't need it for their daily cash flow. and they were able to rely on that. And I said, if you're not doing that now, there's no telling when the next economic storm is going to hit. So do it now, get those in place and work on it. And then 2 months later, the world shut down. And the people who had lines of credit were able to take their time to see what resources were out there, keep their business operations going, and leverage that line of credit so that not only could they get through that shutdown, but they were the ones that were able to take advantage of being one of the survivors in the market with less competitors now and thrive a lot more quickly.
When you hit a epoch moment like that,
Mm,
and either as a strategy or all of a sudden, a pandemic rolls through again,
mm,
does the customer come to you and say, "Listen," and much like the human body, when you're in fight or flight, certain things are done less. Where you normally had a margin, that you have none. And if you're not breathing, it's never good, right? There's the kind of the key critical items. Do you provide a quick assessment saying, "Listen, you've just hit a pocket," and it could be it could be global, it could be national, it could be just
mm,
local, or it could be just industry specific. All of a
mhm.
sudden, no one let you make leather products. No one wants leather products anymore because
Yeah.
it's socially unacceptable. Do
Mm.
you provide an assessment saying, "Okay, keep yourself going. Other than getting that line of credit ahead of time, this is what you got to do to
Yep.
kind of go dormant."
Yep. And that's the other thing too is risk versus reward, right? How much risk do you have an appetite for and knowing what those risks are? A saying that someone told me once is that redundancy breeds growth and efficiency breeds profitability. Too much redundancy and you're never going to grow and you're never going to be profitable. Too much efficiency and shocks to the system are going to knock you out of business. And, it doesn't matter what your profit margins are if you're only making $10,000, right? So there's a balance there that needs to be attained. And there are certain things you can do with insurance, with lines of credit, and other means to help mitigate those risks. But at the end of the day, you have to be aware that nothing is ever going to be perfect. Nothing's ever going to be foolproof, but you do the best you can. And if you do that, generally you're going to be okay. You're not going to get caught flat footed. And you may need to make some decisions that are hard, but your business is far more likely to survive and thrive rather than saying, oh, I'm just going to risk it all and see where the chips lay. That's never a good plan. And if that's your plan, you're probably get better odds at Vegas.
Thomas, our listeners are in various fields and at various places of their business, so I like to break down acronyms. What's PPP?
That was the payroll protection financing that the government put into place. People were able to apply for loan based on their payrolls to keep people employed. And based on that, they were able to get some money. And then that, as long as the application was met the guidelines, later on, they were able to get those funds forgiven, meaning that instead of paying back that as a loan, the Small Business Administration would treat it more like a grant. So that is what PPP is the payroll protection financing that the SBA rolled out to help small businesses survive because it was such a huge shock to the system that even companies that had the best plans, it was going to hurt them. If they hadn't done that, there would have been an economic collapse that would have made the 1920s depression look like a small blip on the radar. Because with everything being shut down, everywhere would have gone out of business and there would have been a cascading effect. So it was the government's way to prop up small businesses, to keep people employed so that the economy didn't completely collapse under the weight of the pandemic. So we can service clients anywhere in the United States. We currently have clients in all four US continental time zones. Still working on a couple of prospects in Hawaii, but not yet. And our people, we've always been a virtual solution since 2015. So while the pandemic was horrible for most businesses, we were very well prepared because we were already using those virtual tools and working with our clients that way. So we can work with clients in any geography as long as they're comfortable with a remote solution. In terms of who we're looking to help, I would probably say that the business owners that are in the right mindset are usually making at least 2 million in annual revenue gross. And our largest client today is doing about 50 million a year. So most of our clients fit between there. 5 million to 15 million is a very good sweet spot for our, so I want to say 80% of our clients are there, but we can go larger and smaller based on those clients. They just, as I always tell people, we're a huge value, but we're not cheap. If you're looking for the lowest price and you're looking for fast and cheap or good and cheap, we're not going to be that solution. We are the good and fast. But when you look at the impact that we can have on managing that bottom line, like that story I told you before, and the focus that we can give on business owners growing the top line with good margins, our net value is going to be far better than many of competitors that would underprice us or outsource their labor outside the US and have other cost cutting measures.
So LinkedIn, website, phone number, what's the best way?
Best way is our website at brightwayadvisors.com. If you're interested in our services, there's an email there you can use as well as a contact form. If you want to reach out to me directly, it is thoward@brightwayadvisors.com. And that is my direct email address. And I'm always happy to have a discussion with folks. The last is our phone number that is on our website. You can use that. That goes into our admin, Nicole, because she screens those for us. And then she'll make sure that you get to the right person to talk to.
One last thing is I'm actually going to start a challenge. It inspired me. Accounting and swordplay as a combined. I think that's the future. If we wanted to see this, where will we get the manuals, Thomas?
So if you are looking for the stuff that we do with the swords and the fire, phoenixswords.com. And that'll have links to our upcoming performances as well as to our social media pages.
Thomas, I want to say thank you so much for taking your time today and walking us through, things that a business should have in place. I'm my co-host, Wayne Pratt, and you're the Knack for Business listeners. So if you're starting out or you're in business and you're going, gee, where's my money going? And, am I spending too much on one area and not enough in another area? But Thomas's crew is the one to reach out to. And if you need to know about swords, fire, and dragons, Thomas is your man.
To reach the podcast hosts, email them at info@creativeinsight.com or by the website creativeinsight.com, spelled KREATIVISIGHT.com. To reach Wayne at his email, wayne@motive8u.ca, that is MOTIVE, the numeral 8 and the letter u.ca, or his website, motive8u.ca. If you would like to be a guest on this podcast and share your knowledge, let us know. We would also appreciate your feedback on the content or format. Check the show notes for more details. For these podcasts, we like to acknowledge the support and thanks to the following people. Carl Richards from Podcast Solutions Made Simple, a renowned podcast expert. Fred Crouch, who is the Property Wizard podcaster, where Bernie is a co-host. Jovan Strika from At Hive, a co-working space that is more than just a space. Then Melanie Weber, Bernie's invaluable business partner, and Wayne Pratt from Motive8U Inc., who serves as both a coach and co-host of these podcasts. Disclaimer. Please note that the Knack for Business podcast episodes are meant solely for educational and general informational purposes. The information and opinions contained within are not intended to be professional advice on any subject matter. The thoughts, views, and opinions expressed by the participants are their own personal beliefs and do not represent the views of the podcast hosts or any affiliated organizations. It is important to note that this podcast is not a replacement for consulting with certified experts in your area who possess knowledge of your unique situation. The hosts of the podcast, along with any participants or affiliated groups, do not take responsibility for any actions taken or not taken based on the information presented in this episode. It is highly recommended that individuals seek guidance from their own personal advisors in fields such as accounting, law, or other pertinent areas prior to undertaking any actions or making decisions that may impact their financial, legal, or other aspects of life.